GM, good morning. Welcome to the Milk Road Show, the daily crypto show that still thinks you're big and beautiful, even if your name's not Bill. I'm your host, Jay Hamilton. It's Tuesday, July the 8th, and today we're joined by Arty and Gamma, the founders of Market Radar. This is an awesome platform that really gives retail traders access to institutional grade systematic trading tools. These guys are full-blown quant trading, and we're going to get their input on the macro setup right now. We're going to talk about the big, beautiful bill. What's the impact going to be on markets? How's the market and the US economy going to deal with all this debt? We're going to talk about tariffs and trade deals. The tariff deadline has been pushed back. It was supposed to be tomorrow. Now it's been pushed back to August. We're going to talk about that. We're talking about the conflict between Trump and Jay Powell that just seems to continue to go on, and what it might mean if we have a shadow Fed chair, and so much more. Just an awesome episode. Before we jump in, I got some really exciting news. Not only are Arty and Gamma on today's episode, also our new Milk Road Macro podcast host is on today's episode. I'm talking about John Gillen joining us. John is a former VP at BlackRock and currently also a crypto fund manager at Tru Capital, where he serves as their head of research. He's an expert in all things macro and digital assets, and he's going to be taking over the show for me. We're going to have a transition period for the next month where I'll still be on, but eventually John will be your Milk Road Macro guy. Today's episode is brought to you by Definitve, the leading terminal trusted by funds, DAOs, and top traders. It's also brought to you by Ledn. Get cash without selling your Bitcoin. Without further ado, Arty, Gamma, and John, welcome to Milk Road Macro.
Thank you for having us. It's good to be here.
Jay, that was great.
It's funny when there's four people, nobody knows who to respond first when I ask a generic question like that. So thanks for filling the space there, gents. Really appreciate it. Okay, let's start with, I always like to start 30,000 foot view. And I know that at the beginning of the year, you guys made some pretty good calls, and you saw what maybe a lot of the rest of the market didn't quite see yet in January, which was that Trump was going to go hard on austerity and cutting budget, but that you guys said he would most likely come back on that and change his tune, which obviously the big, beautiful bill has shown us that. And then you talked a little bit about the Fed and what you thought they might do as the dollar takes it on the chin, and where they might go with rates. When you look at where we are right now, midway through the year, what's standing out to you in terms of the macro framework and the macro setup right now?
So I think the most important part here is that we don't really take a political approach. Well, as you were saying with the big, beautiful bill, we have our political opinions and we'll certainly discuss them, but we don't let that cloud our investment decisions, right? Because the way that we face the markets is more systematic. So basically, as the signals come in, we react. Now, sometimes there's some noise, like there's no perfect system, but it allows us to kind of take the political bias away from our positioning and prevent us from putting ourselves in a position where you kind of lose sight of the investment thesis because maybe you're gung-ho because it's golden bull run, or you think maybe that this sector is going to do really well for whatever political reasons because it's in the big beautiful bill, etc. Right? So what we do is we take a step back and we approach markets from a risk perspective, either risk on, slow down, or risk off. And a good way to break this down would be our macro regime chart here, which is updated daily. It's on our website. It's interactive. It feeds out, it basically as an output of our signals, and you can watch how this progresses day to day and get a real-time gauge as to where we are in the risk spectrum. So what this basically means is risk on is where growth impulses are positive. Slowdown is in an environment where growth impulses are negative, but they're not necessarily in a terrible area. It's more so chop in the markets, expect consolidation, don't really expect raging breakouts, and don't really expect, just consistent bull runs. And then on the bottom, when you're outside of the slowdown barrier, it's risk off. And that's where things kind of get pretty nasty in the markets. So our call for the beginning of the year was pretty simple. Christmas Eve of last year, we left risk off. We have yet to be in risk off since 2024, but it looks like, we left risk on and we went to risk off. We've yet to be in risk on since 2024, and it looks like risk on is coming back. So the big change there was us leaving risk on at the end of last year, and we pretty much were able to kind of see that the growth impulses were losing strength, and therefore the outlook was more to the down, had more downside risk than it would in a risk on environment, which allowed us to become more defensive and essentially just walk back a lot of the bullish outlooks that we had going into the end of last year.
When you look at the rest of this year, what's your outlook right now? Do you think that we will go back to the risk on category? It's interesting. Your systematic view and your quant based view in trading, I really like, because so many of the guests that we take on the show they have obviously a lot of quant behind them, but they also are gut and feel a lot of the time, right?
Well, there's nothing wrong with the gut and feel approach, because here's a good example, right? If the market falls 30% in a risk off environment, the odds of you being in a more lucrative position buying stock with the market down 30% is exponentially higher than at all-time highs, right? In terms of you making money, right? The upside is just there baked in, because you're basically betting that the stock market will print another all-time high again. But from a systematic perspective, the way that we approach the markets, our positions are leveraged 3x, right? We use 3x leveraged ETFs in our models. And for us, taking 50, 60, 70% drawdowns in these leveraged ETFs is not part of the game. First off, it's extremely uncomfortable, right? And I'm sure some of your listeners would understand that's like altcoin territory level volatility, right? And when we have a large amount of our net worth tied up in these leveraged ETFs, we need to be tactical to the point where, you don't want to get caught up in unnecessary chop. Like, drawdowns will happen. They're part of the game, but you don't want to be in a position that you could have avoided. And I think that the systematic approach kind of takes out a lot of the guesswork for us, but the discretionary side, there is still a lot of alpha to be had, right? A lot of top hedge funds are not systematic. They're discretionary and they can do well. So it's not just something that, one size fits all. It's, again, down to how you want to approach the markets. But back to your question about what we think the market's going to really do here for the rest of the year, I think it comes down to one specific thing. And it's really as non-political as you want to get. I think the market's been somewhat politicized to a very extreme degree the last year and a half. Last administration, there was the IRA. It was pretty straightforward. People were talking about government job manipulation, et cetera, et cetera. There was a whole narrative behind that. But in this administration, it's hard to get a footing because things are constantly shifting. And the way that things are breaking, the way the headlines are breaking, are almost as if there is no actual. The market has a hard time finding the directionality behind these headlines. It's not like we're doing these headlines in this order to reach this goal. It's almost like we're on the sporadic path of just every day could be a different headline. And I think that's probably the biggest problem in the market right now. And it's probably going to be a hurdle for some time, given, just today we had the 50% copper tariffs come through and some more tariffs that are likely to be announced soon. And these are just things that are coming kind of left field, and the market does not like uncertainty.
Mm-hmm. Mm-hmm. So you see the uncertainty continuing indefinitely, right now.
I think you have to ask yourself this: with every president's unique, with the current administration, do you think there is a level of certainty, and do you think that's going to be there's going to be a level of persistent certainty, or is it more of just we move the goalposts on a daily basis? And again, not being political, just how the headlines are falling, doesn't really matter who's in office. If the last administration did the same thing, I would say the same thing. It's just a matter of how headlines are coming out and the way that they're just spontaneously, we're deciding things on basically, it seems like on the back of an envelope, and the market is trying to figure out exactly where, it should be shaken out to. And I think that's probably the big uncertainty. And then backing all that was the big beautiful bill. How that basically came into play here, it's starting to feel, and again, we're separating our feelings from our signals. Whatever our models do, we're going to do no matter what we feel. But it's starting to feel like the tariff walk back in April was somewhat of a factor toward getting the bill through. It almost feels like the way that everything was walked back and it's just suddenly magically coming back to fruition, coming back on the table here to be debated for the tariff headlines right after the bill passes, and it was walked back into the voting process. Almost feels like the market was down too much for at least the administration's acceptance going into a vote, and they wanted the market higher for the vote. That's what it feels like.
Mm-hmm, mm-hmm. Yeah, I can resonate with that feeling for sure. Okay, let's talk about some of the things that you've mentioned here. Let's talk about the big beautiful bill, because while we might not have certainty from the administration in terms of what they're going to do day to day, we do have certainty in that the big beautiful bill has passed through the Congress.
This is true.
And so now the question is, what's the impact of that going to be? How are markets going to react? Let's talk about when you look at the big beautiful bill, how do you think that it's going to play out in markets over the short to medium term?
The big beautiful bill overall is pretty much stimulatory, right? It's a net positive for markets growth, however you want to see it. Now, you can argue that there is some hidden risk within the bill around immigration, right? Mass deportation, you can argue that it maybe skews the workforce, right? And you could say it enhances it. Some would say it enhances it. Some would say that you're opening risk for negative growth shocks due to labor shortages and whatnot. But that's an entirely different debate. Overall, the bill is a net stimulant to the economy. Now, I think that what's going on here is pretty simple in terms of directionality, right? So the big beautiful bill is going to stimulate the economy. And the problem here is going to be the deficit, right? So the deficit is going to widen, right? And the deficit's going to go up, basically rise. And in that, what's going to happen is the Fed is in a position where the economy is essentially, this big beautiful bill, the level of stimulus that's coming out of the bill, we don't necessarily need that, right? You would do something like cut taxes or widen the deficit if the economy is running under its economic potential, essentially borderline recession. You're afraid that you're going to deviate too far from meeting the capacity in the economy. That's when you really want to run a deficit. But we're above capacity right now. And the issue here is that the Fed's been at over 4% for 2+ years, and inflation is only moderately falling at this point. It's not like inflation is falling like a rock, and it has nothing to do with tariffs. It has more to do with the fact that we are running extremely hot fiscal deficits in an environment that doesn't warrant it. And then we're asking the Fed to basically pancake the curve and fuel the deficit even more. And I think that that's the uncertainty here that's going to be, moving the markets in terms of policy path of the Fed. But in terms of the big beautiful bill itself, it should send the market high. It should act as a net stimulus for the market as long as inflation doesn't detach or de-anchor or unanchor and run higher and force the Fed to basically hike rates.
Let's talk about the timing of these two things, because you mentioned two things there that are so key to understand. Is like, one is net stimulus as a result of this bill. Would love to hear what your thoughts are on like when the markets will start to feel that stimulus and when that might come. And then the other is the more longer term, is the impact of this debt and how the U.S. economy is going to deal with a growing deficit. And do we need to brace ourselves for this at some point? Like, can we get a recession at some point? Is it even possible to get a recession anymore? It certainly feels like
you're asking $1 million question right there. Honestly,
that's the big one. We've been asking that too. Like, is it even possible at a 6% deficit? But according to our system, the growth index has just been rising for the last few months, like pretty well, like very strong rise in growth. And I think that's partially due to the expectation of the big beautiful bill and the stimulus that it's going to be providing. So I think we are already seeing that getting priced into the market, but obviously it's not fully priced in. There's no way to fully price it in just yet, but it is something that we have been seeing, and I do expect continuation from here.
Yeah, and I think the big factor here with the big beautiful with the stimulus and whatnot is going to be essentially how you feed the economy, right? So if the deficit rises and it's because the Fed isn't necessarily, I should say this, if rates are rising to combat inflation, it's a lot different than rates rising because of fiscal instability, right? Because if rates are rising because the Fed's hiking rates, that's a completely different outcome than the rates rising because the Fed is basically de-anchoring inflation expectations and letting the dollar go to hell.
So growth looking good. What I'm hearing is you think we in your models we might be heading towards risk on soon. Is that accurate?
Yeah, pretty much.
Yeah.
Like we don't front run our system. That's the thing.
Of course.
We really have to stick to it. But yeah, we are pretty much on the precipice of going risk on. And it's not like we're coming from full blown risk off. Like we've been in a slowdown this whole time, which just, it doesn't mean markets can't go up in a slowdown. It just means you have to be a bit defensive because the market could just get blindsided by something. That the odds are just in the favor of that when you're in a slowdown. It doesn't mean it's going to happen, but it can. So it's better to play defensive, especially when you're using triple leverage like what we do. But yeah, we are on the verge of going risk on. And as soon as that switches, we're going full blown into risk assets.
In traditional finance, whales use the Bloomberg terminal. In crypto, they use Definitve, the trading terminal built by Coinbase alumni, which lets you trade across every major chain out there. Definitive's combination of low fees and advanced order types like limit, stop loss, and take profit make it one of the best on-chain trading experiences there is. The kicker, Milk Road listeners trade free on their first 25,000 in volume. Visit milkroad.com/Definitve and start trading like a pro today. Selling your Bitcoin should be a last resort when you need cash. That's why there's Ledn, the trusted platform for Bitcoin-backed loans. You can unlock cash in as little as 18 hours with no monthly interest payments and no prepayment penalties. They've issued over $9 billion in loans and never lost a single Satoshi of client funds, even during the chaos of 2022. If you're a long-term hodler, this is the move. Get liquidity without selling at milkroad.com/Ledn, spelled Ledn.
Okay. Very, I like the bullish sentiment coming out of you guys as you're also so reserved and capable of sticking to your mandate, which is very impressive. And I think something, honestly, something that all investors could learn from is just, really being disciplined throughout your trades and through your investments. Okay. I want to shift slightly here to talking about tariffs and trade deals, because that's the other big factor right now that's coming out of this administration that is impacting markets that we're all trying to figure out and all trying to deal with. So basically where we're at is we had Liberation Day, huge impact on markets. Do you think that could happen again with tariffs, or has the market priced in tariffs enough that we won't have another major scare as a result of tariffs?
Well, I think the tariff issue is obviously quite dynamic, right? Because it really depends on the level at which tariffs come in. So, if it's more of the same as what we were seeing where letters are getting sent out daily and the market doesn't seem too spooked. But I think if you start really walking back a lot of the progress that was made since the post-Liberation Day lows, the market's going to probably have a hard time.
I think also there's a bit of credibility that's been lost throughout all of this. I think the market is kind of realizing, okay, like Trump goes in hard with tariffs and then he walks them back. So I don't think we're going to get the same level of scare, obviously, unless he pulls out another one of those poster boards with just ridiculous tariffs. But I don't think that's going to happen again.
Yeah, that's a good take. That I think everybody sees the playbook now. And as a result of that, is less reactive to the playbook, unless, like you said, there's some big show and tell moment, which I wouldn't put that past Trump at all.
Yeah, honestly.
Okay, so when we look at tariffs, like the thing that stands out to me is the constant change that just keeps happening around the deadline of these. And as you know, Gamma, you said, letters keep going out of, you know, Trump saying, get off your ass and let's make a deal. And I'm not sure what to pay attention to within the tariff mania. Like, is there anything to pay attention to in your view?
I think that ultimately this comes down to a very simplistic take. Trump, it's very clear that Trump's not going to let the markets go too far. You know what I mean? Like, NASDAQ down 20% was probably a good, 400 on the NASDAQ was the floor basically on the QQQ on the last tariff route. And I don't think like Trump would even let the market go down to 400 again on the Qs, right? Like this is a game, right? Where how far can he get without destroying the market? And I think that's the game that's being played. Now, in terms of how that kind of plays out, I think that we're on the precipice of risk on, right? Because the caveat to all of this, and this has sounded somewhat bearish up until this point, but the caveat to all this is, as Arty just said, you've shaken out a lot of this uncertainty to the fact where there's a loss of credibility. Like, is there actually going to be a persistent tariff plan that's put in place that's going to go the extra mile? It's not going to be walked back last minute, extended, or a backroom deal that's made or cut. Like, that's the real question here. And on the bullish side of things, you kind of saw a lot of the tariff shocks washed out of the market, right? Like, we saw the huge negative impulse there from when tariffs came out with the poster board. And unless he kind of one-ups that, it's hard to say that he's going to basically top out the market and send it lower. And with the big, beautiful bill passing, net stimulus, debt ceiling being raised, ultimately, at this juncture, he's going to have to probably put another bill through of some sort before his term is done, right? And that the stimulus is likely going to just keep on coming. So this goes back to what I was saying earlier. It really depends on what is driving up interest rates, because a lot of people are looking at, for example, the 30-year interest rate, and we're above the Trump inauguration level, 30 years popping, but equity markets are okay. And there's a difference between interest rates rising due to term premium and basically fear of getting debased, right? Real yields going up, term premium going up, volatility risk will drive term premium higher as well. And there's a difference between that and then the benchmark rate going up, where essentially it's due to just the Fed hiking interest rates, right? Because if rates are rising on the idea that the Fed is going to have a risk to its independence, therefore bonds just inherently become riskier without the Fed having to move policy. What that means is you can call it like a heightened debasement risk, right? And if that debasement risk is heightened, equities won't actually get hit on yields going up. Because if you look at it from a traditional perspective, rates rising and them hurting equities basically is a sign of higher funding rates and higher benchmark risk-free rates. But if the rates are rising because they're no longer as deemable or as risk-free as they eventually were, then what that basically means is equities don't necessarily lose some spotlight there. They are still competitive and they can still perform with rates rising. Whereas when we saw in 2022, when the Fed was jacking up rates aggressively, what they were doing is they were lifting that risk-free benchmark rate up so high. And with it, the market was feeling pain because it was flowing into all the companies that are leverage or rely on that risk-free rate. Whereas if you do it the other way around, where rates are rising because there's a debasement fear or there's a term premium fear, it doesn't work the same way for equities. So that's why when you look at rates, you can't just say, oh, rates up, it's bad for stocks. Rates down, it's good for stocks, because it really depends what's driving the move in interest rates.
Yeah, and actually that increase in risk through treasuries could possibly even bring more capital flows into equities, because that risk difference starts to shrink.
Right.
So I want to kind of drill in a little bit more on this conflict around interest rates. We have two sitting governors of the Fed board who are openly dissenting with Powell's choice to not cut rates, and they're calling for rate cuts. The sitting president and vice president are openly almost bullying the Fed chairman, right? Calling him stupid to the media. Who's going to win this tug of war, and why are both sides fighting so much over this at this key point in the where we are in the markets right now?
Well, as if you're invested in U.S. equities, you want the Fed to win the war. You do not want the Fed to lose the war to the point where they become a third, an arm of the president's office. That's the last thing you want. Anyone that owns U.S. denominated assets would certainly not want that. Now, there's obviously a big hurdle here to understand, because when you have the Fed board or individuals at the board dissenting, the degree at which they're dissenting and what they're calling for matters a lot, because if you look at it, the Fed dots are already indicating, as per June, that the Fed is going to cut rates this year. It's already the Fed basically is telling you they expect to cut rates in 2025. So rate cuts are coming, and the market is expecting pretty much around 3 to 4 cuts by this time next year, roughly. So the market's expecting 3 to 4 interest rate cuts by this time next year. And, now you're just playing a game of dissenting between how long they want to wait until they start cutting again. And are they going to wait, one more meeting? Are they going to wait till September? Meaning, are they going to do it this month? Or are they going to do it in September? Are they going to do it in October? When are they going to start or kick off the wave of cuts that they've been forecasting in the dots? That's really the question. The problem here is differentiating what the Fed is implying and what the governor or board members and governors are dissenting against versus what the president is asking for. The president is asking for basically to cut the Fed funds rate in half, like almost immediately. Now, there's a very large difference between putting 200 basis points of cuts on the table immediately and arguing over whether they should cut 25 basis points at the next meeting.
It's almost comical.
Right. And I think that's like a very touchy subject, because obviously, you have the administration gung-ho, Powell's a fraud. Typically in government, nobody's clean, right? Everyone's hands are dirty. So how this comes down and who's innocent and who's not, I don't know if that's really the debate we should be taking. The question we should be really having here is there were fundamental reasons why the Fed had to cut or decided to cut interest rates last summer into the fall. And there's fundamental reasons to why they stopped cutting rates. And that's basically due to labor shocks accelerating and then decelerating rapidly. Now, what the Fed does from here, how they want to ease cuts through, is a different story. I think that the Fed it seems like they have the room to cut. The question is again, 25 basis points or 250 basis points. And the administration wants the way Trump seems to be looking at this is he looks at the Fed funds rate as basically a marker of just where he was last presidency. It almost seems like last presidency, he had rates at 2, now they're at 4. And in his mind, he's like, I want them back where they were when I was the president last time, because when I was the president last time and the rates were that low, the economy was booming. Everyone said it was booming. A very simplistic approach would, I think, suit the situation well here, where Trump just thinks for the economy to really roar, rates need to come down significantly. Now, the more complicated approach here to what I just said is the fact that it's fueling net interest expenses, right? Rates being this high are fueling net interest expenses, and they're costing spending categories on the deficit. You're basically half the deficit, right, is essentially interest expenses at this point. And the government looks at it very simply, I would assume, in Congress, when all the doors are closed and they look at each other, at some point they're going to say, look, we want to bump up, maybe we want to bump up Medicaid spending. We want to bump up, social services. Maybe we want to bump up education, but none of us can have our way. And we want to bump up defense, right? Every party has their own spending categories, but we can't do anything because interest expenses are so astronomically high. What happens if we just get interest expenses down via lower interest rates? We can then afford to spend where we want to spend. And I think that's the ultimate problem here, is Trump's being taken as a guy that's going to, quote unquote, blow the deficit higher with the big, beautiful bill. But in his mind, if interest rates were half of where they are today, the deficit rise wouldn't be as real. And the problem with that is the reason interest rates are so much higher than where they were when he was president the first time is the deficit is nearly twice as high. So the deficit that we're running is grown basically 100%. So not that they're, it's not point for point. There's no mathematical equation to measure where interest rates should be up here due to deficits down here outside of maybe a Taylor rule. But ultimately, interest rates are offsetting the fiscal stimulus that's being pumped into the economy through the higher deficit. So this comes back to our whole point. We'll tie this all together, that if the Fed were to cut rates in half with an economy that's already running above potential with a recessionary level deficit, you're almost guaranteed to have this bleed right back into inflation. And that, I think, is the risk that which the Fed is. I don't think it matters who you put in the Fed's chair position. They're not going to cut interest rates 200 basis points. I think between the board of governors, there's enough consensus there to understand that, you could debate, look, over the next year, do you want 4 cuts or do you want 6 cuts? It's not a debate of whether you're going to cut 200 basis points next month.
Mm-hmm. Gotcha. Mm-hmm. I'd like to come back to the something you said as well. So you said it's everybody sort of agreed that we're going to have rate cuts, right? It's just a question of when that timing is going to be. And as you've said, we're kind of on the precipice of risk on. Arthur Hayes has written one of his famous blog posts recently, basically saying something similar, right? Like, all roads lead to debasement of the dollar. We're going to go back to spending. Risk on is coming. So just get allocated now and front run that. Walk us through the thought process of your systematic system of waiting until you get that signal. Like, what is the risk of getting in before that signal fires now and just knowing we're going to have risk on soon versus waiting too long and maybe missing the best entry? Like, walk us through like what drives that change in that model for you guys and what you see, like how you think about that allocation decision.
Well, there's a good summary to what you just said, and that being when you position yourself via systematic approach, right, where risk on is defined as bullish growth impulses. It doesn't really matter where inflation's going as long as growth impulses are bullish. You're essentially in risk on territory. Now, the issue with front running this, you can do it. Some people, we've seen people do it. We've had some luck doing it ourselves in the past, but we've reverted from front running our own models because what happens is the times where you don't get the pivot for whatever reason. Here's a good example. Maybe next week we go on a tariff rampage, whatever reason, risk assets go down 10%, right? And like we were saying earlier, maybe that acts as a Trump pivot. Trump sees the market down 15%, 10% is like, all right, I'm going to do another walk back. But by you front running the system, you've put yourself into leveraged risk exposure or risk on exposure. And now you're taking a drawdown where you don't have a real exit plan because the system isn't going to flip. The way this works for us is us flipping risk on, and the trends aligning and basically our rules aligning, we open up risk exposure to the upside. But for us to get out, either the trend has to break on the asset that we're long or the regime has to break. If you front run the model, what ends up happening is you have one of your safety checks no longer are there. So what's going to happen now is you're going to be in a position where you don't really have an exit plan, and the odds of you getting hurt to the downside on whatever may be, 20, 30%, not saying that it won't recover. It's just not fun volatility wise, right? Especially with the leverage factor of 3x, a 10% drawdown in the NASDAQ is 30% drawdown in the leverage product at least, and then 80% of your P&L being in that, you're talking about 24% P&L drawdown, and that's not fun when it could be avoided.
It doesn't sound fun for anybody to see a drawdown like that. But if you're in crypto and you're trading altcoins, we're
no,
used
that's
to
different.
That type of stuff all the time.
Yeah. I mean, we definitely have some of our members, and even us, we can kind of see that a risk on pivot's coming, and some like to take advantage of it by just chasing risk. And there's nothing wrong with this. It's just you have to have backup rules in place. Like everything is, there's no one size fits all. Like I said earlier, you can add discretion to the systematic approach. You can get creative with it. It just comes down to how you want to manage your risk. And for me, it's easier to know that the signal says get out, I get out, and the signal says get in, get in. And I don't have to sit here and be like, did I make a mistake? Maybe I shouldn't have. Maybe I should size up. Maybe this is just a dip for ants and I can basically pile in leverage even more to make up for my ridiculous, pre-entry that got smoked. It's a bunch of ways this can go wrong, right? And by me just following the rules, at least for me personally, because we run our own capital in this ourselves, right? For me, it makes sense just to wait for the rules to trigger and snap in and out of the proper regimes and then just kind of lay it up, right? Instead of sitting here trying to like reverse engineer or basically drive myself crazy when the rules are there for a reason.
Yeah, it seems like a great system, which, hey, when you follow it through, then it makes a lot of sense. I want to, Arty, you mentioned earlier that when you go risk on, that you've got a bunch of assets that you'll be looking to accumulate and acquire. What can you give us a breakdown of what assets you are looking at and where you're thinking about allocating when we do go risk on?
Well, we keep it pretty simple with the model that we provide. We just go 80% of our portfolio into triple leverage NASDAQ, and 20% of the portfolio is in Bitcoin, which that we enter during slowdowns as well, just because historically Bitcoin also performs well during slowdowns. So we've already been in that. But yeah, we would allocate just triple leverage NASDAQ. But obviously there's a million different ways to skin the cat. Like you can go into semiconductors or other high risk assets. That's when they perform the best, is during risk on regimes. And
even some altcoins, right?
Yeah, altcoins too. Like every single altcoin bull run happened during a risk on regime. They do not happen during risk off regimes. So even just having that guideline and just knowing when it's time to get in and when it's time to just chill and just stay in cash, if you're trading altcoins, it's a great indicator for that. So there's plenty of different ways to take advantage of it. And typically when our system triggers risk on, it also tells us that it's going to be a somewhat long lasting regime. It doesn't trigger easily. So when it does trigger, it's something that's going to last a while. Growth impulses are gaining momentum and we're going to be in a positive growth territory for a decent amount of time.
Can you, Gamma, I see you pulling up stuff on your screen. I'm going to share you again. Can you show us that's what I was going to ask, historicals?
Yeah. So what I'll show you guys right here is basically what it looks like going back to 91. The green, this is filtered for risk dynamics, right? And then obviously with the regimes are the 4 regimes we were speaking about earlier, but understanding the risk dynamics are more important because that's where it doesn't see if you're in a deflation regime in risk off or you're in a stagflation regime in risk off, it doesn't necessarily matter. What matters more is in your risk off, and same with slowdown and risk on as well. You may have some sectors that perform better in expansion versus inflation, but in terms of risk assets overall, they go up in both these regimes. So basically dissecting where we are with the regime, you can see here that in a risk dynamic filter, when we have risk on, which is green enabled, the market does pretty well. And in risk off, bonds tend to do quite well too, depending. In 2021, we had the infamous stock bond correlation go to 1, where the Fed was hiking like maniacs and bonds were getting smoked, and so were equities, and bonds were not a long at this period. They were bearish trend. So this is the most important thing with us, is we have a double filtered system, right? So in layman's terms, just because we're in a risk off regime or risk on regime, if the underlying trend doesn't align, we are not going to allocate chips to the trade, because it's just all factors need to line up, especially with leverage. You don't want to be caught in a situation where, just because it was a risk off regime in 21 and the Fed was hiking rates, there was so many bull cases as to why you should buy bonds and wear diamonds all along across that drawdown, right? Everyone was like, oh, this is the bottom. Rates are going to peak here, turn around. And that was when like the 30-year was at like 1.5 or 2% or something like that. And then it just kept going. And the problem with that is if you don't have the trend filter on the asset that you're buying, you're going to run into a situation where you don't have, again, going back to front running the rules, that double protection and being able to get yourself out of improper trends, even though the system may not see it just yet. They both have to see it for you to be in it. And as you can see here, as Arty was saying, risk-on's regimes do happen. They are pretty consistent, and they're great to be long risk assets. And it looks like, as you can see here, we outside of maybe, the GFC, where we basically were down bad for quite some time, risk off periods don't necessarily stay around for too long, risk off slowdown. So we've seen this long period of risk off slowdown now, about 6 months. It does seem like we're about to get another spurt of risk on.
Seems like a pretty good setup as we go into the rest of the year, and love to hear, especially for all our listeners who I know hold bags in altcoins, are going to be quite happy to hear that finally might be an altcoin season, because it's been a rough year and a half, as Bitcoin has just absolutely dominated every altcoin, unless you held meme coins for a minute or a few select tokens for a minute. But on the whole, gents, absolute pleasure to get you on the show today. For all those listening in who want to follow you and want to learn more about Market Radar, where can they do that?
They can follow us on X at the Market Radar, or go to our website at www.market-radar.com. We do have some free products that you can sign up for. We've got a free macro dashboard. We have a free Discord. You can ask us any questions you want. We do our own live podcasts in there as well, so you can come listen in and have a chat with us.
Right on. Awesome. Yeah, really appreciate all the content you guys are putting out, and I think it would be great value to our listeners. So make sure you guys go check out Market Radar. I got to remind you guys, as always, that none of today's show is investment advice. I'm not your investment advisor. Neither are any of these other guys that were here today. So you should always take time and do your own research before you make investments, because investing is risky and difficult. And if it was easy, everybody would do it, and we'd all be millionaires. But we're not. But that's why you tune in to the Milk Road Show, so that you can make the wealth that you're looking and achieve your financial dreams. Thanks so much for tuning in, y'all. Have yourselves a wicked awesome day. We'll see you back again tomorrow.
If y'all are making swaps or trades right now, highly recommend you check out Milk Road Swap. This is a DEX that we built in partnership with Cow Protocol. Why did we build it? Not to make money, just honestly so we could have a place to do our swaps for the lowest fees that we could find. This is the fees on Ethereum, Arbitrum, and Base are only 0.15% fees. This is a huge difference from other centralized exchanges that charge 0.5% or even up to 1.2% fees on their swaps. Also, you can swap on Solana, all at swap.milkroad.com. Check it out today. You won't be upset. And you can join me in my favorite place to make swaps on chain. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.